program is sponsored by the Burger Funds.
Good evening, everybody. Welcome to another edition of Your Portfolio. I'm Bill Griffith. Let me just tell you up front, we're going to open the phone lines and do an instant poll. We haven't done one in a while. Give us a call right now. You'll know the answer. I'm going to ask you a question. You know, each month a private research organization called the Conference Board releases its much-anticipated report on how Americans feel about the economy. Well, today's data revealed that many of those who were polled are pretty upbeat about the way things stand at the moment. Consumer confidence jumped in April to its highest level in nearly 4 years. The Conference Board's monthly index rising 5 points to 91.7. More people expressed optimism over business conditions and job opportunities. What we want to do tonight, though, is put a Wall Street spin on this story and ask you how you feel about the current investment climate. Are you bullish? Are you bearish? Maybe even neutral at the moment, and why? So we're opening up the phone lines. I want you to give us a call now, and we'll do our instant poll. 800-752-CNBC. There it is. Are you losing sleep, worrying about what the market is doing? Are you nervous about rising interest rates? The phones are open. Call in and talk to us. Who's on the phone? Where are you calling from?
It's Roger. I'm calling from Maywood, New Jersey.
Hi, Roger. You bullish or you bearish or what?
Well, I'm bullish.
Meaning you're still buying right now?
Yeah.
You feel this is a market correction?
Yeah, the NASDAQ dropped down to about 720, and I think that's a big buying opportunity.
Even if interest rates continue higher?
Depends on how high. You gotta watch Greenspan. I don't see the inflation, though, and I really don't think he's going to get it up much past 4%.
Okay, thank you. Who's on the phone? Where are you calling from? Hello? If you can hear my voice, I'm talking to you. Hi, who's on the phone? All right. I didn't think this was going to work. Who's on the phone?
Scott from Long Island.
Hi, Scott.
I'm very, very bullish.
Bullish, all right. So you're buying right now.
I just started buying again. I don't think it's going to go down much longer.
Why?
I think Greenspan scared us all enough, and I think people are used to the way he plays pool.
You don't think that if we continue to see the Fed raise interest rates, that stocks would continue lower?
I think the market already has taken that into account.
Okay. What are you buying right now?
I'm buying auto stocks.
Okay. Why, necessarily?
Just because they seem to... Well, you read in the papers that they're selling more and more cars, and everything seems to be positive, and the earnings all look good this month.
All right. Thank you for your call.
Thank you.
Eric in Michigan, good evening. Hello, Eric in Michigan.
Yes.
Yes, sir. Bullish, bearish, chicken?
Well, cautiously bullish.
Cautiously bullish. What does that mean to you as an investor? What are you doing right now?
Well, actually, I'm looking for intermediate growth with a longer time horizon,
Okay.
5 to 10 years.
So you're buying right now?
Yeah, a little bit.
Not as much as you were before?
Well, it depends on how much we have.
Oh, I see. Okay. But do you feel that the interest rates will continue to rise here?
I think they're going to go up a bit, but I do think that they're going to level off. Probably about the next 18 months or so.
Okay. So you feel comfortable enough to be putting money in when you've got it?
Yeah.
Okay.
Yeah.
Thank you for your call. John in California. Hello.
Hi.
Yes, sir. Bullish, bearish, or otherwise?
I think interest rates are going to go a little bit more, and then I think the economy is going to fool everybody and slow down and see that long bond drop down towards 7 and even lower by the end of the year.
Meaning what for stocks?
I think stocks will be the place to be. I think we'll test our highs again before the end of the year, simply because these companies have streamlined and laid off, and I think earnings are going to fool people. Beyond that, I wouldn't want to go too much further, but I'm certainly continuing to dollar cost into things at this point.
All right. Thank you. Any bears out there? Any bears? George in Pennsylvania. Good evening.
Yes.
Yes, sir.
It seems to me the big move is over. So why be up? Why be in the market for the last 10% of the move? The way the market's been fluctuating, I just figured it couldn't make up its mind which way to go, and I guess I'm with the mavens of that program, the Wall Street Week in Review.
So you're a bit bearish here.
Yep.
Are you selling?
I'm on the sidelines. I took everything out.
So you're out of the stock market right now?
Yeah, and most of it's mutual funds.
How much lower do you feel stocks could go? I mean, you know, those who see a traditional bear market feel we've had roughly a 10% correction to date. Maybe it could become a 25% correction. Do you see it going that far?
I'm not worried about it. I just don't think it's going to go up. It's the risk-reward ratio. We've got the rewards. I think we got the risks now.
But what will the market have to do to tell you that it's time to get back in again is what I wonder.
Well, I think it either have to go up for a while or it has to be stabilized here over, say, 3-month period.
3 months, all right. Thank you. Thank you for your call tonight, and thank all of you. We had one bear, all bulls, so all of our bearish friends out there love that, I'm sure, especially the contrarians who feel that there are too many bulls out there and too many people who feel that this is merely a correction within the confines of a bull market. Thank you, and it was nice to do the instant poll again. By not working, what I meant was they were just going to have me ask you who you were and where you're from rather than me asking you to answer my call for your name. At any rate, it worked. Thank you for your call tonight. Another piece of news here, an unusual bidding war is apparently underway in the mutual fund industry. Listen to this. Vanguard, you know, the second largest mutual fund company in the country, says it plans to up the ante in its takeover bid for IBM's family of mutual funds. Vanguard says that it expects to raise its offer to $17 million. IBM has already agreed to sell its 5 funds to Fleet Financial for $14 million. Shareholders are expected to vote on the Fleet deal in June. But Vanguard Chairman Jack Bogle says that even though a proxy fight may seem like an ungentlemanly thing to do, he is still considering it. Vanguard is one of 8 funds that are vying for IBM's funds, which have $650 million under management right now. We will keep you updated on that story as things unfold. We got the Benham Group maybe merging with 20th Century. We've got this going on. There's a lot of consolidation continuing in the mutual fund industry. All right, we will take a look at the biggest fish in the business in just a couple of minutes. With more than 200 mutual funds and $248 billion in assets and 7 million shareholders, Fidelity is by far the biggest mutual fund company in the world. This Boston behemoth is also one of the most aggressive marketers in the business, offering a vast array of products and services to both individual and institutional investors. However, the company's sheer size left a window of opportunity open for a former marketing executive at the company to publish his own newsletter about the investment giant. Eric Coburn is the editor of Fidelity Profit Alert and Fidelity Insight. These are 2 independent publications that provide information and advice to investors. It's an area where Coburn says Fidelity has come up short. We'll talk about that. Eric is our guest tonight. You'll get to ask him about your Fidelity fund. The phone number is the same, 800-752-CNBC. See you on the other side.
I'm Bill Berger, a father and a grandfather.
Value. Say that Eric Coburn has a kind of working relationship with Fidelity Investments, the kind that you find between a couple that have been separated for some time but never divorced. Back in 1985, he began publishing a newsletter about his former employer, helping Fidelity shareholders get a better insight into the company and providing them with advice on which funds could best meet their financial goals. 9 years, 125,000 subscribers later, Eric Coburn has carved a pretty good niche for himself, and he joins us tonight on your portfolio. Nice to see you. Thanks for joining us.
Thank you very much.
How does that work? I mean, you write it's like these magazines that write about Macintosh, the Apple, or about IBM or something, and you write a newsletter about Fidelity, but yeah, you don't work for them.
Well, the big difference is that we don't accept advertising from Fidelity. So our allegiance is only...
Nor is it offered?
Nor is it offered, that's correct. We talk only to the Fidelity investor and are interested in helping them make the best money possible from their Fidelity investments. Fidelity is never going to tell someone when to sell a fund. We will.
Do you gain necessarily extra access to the managers there, or is the door shut a little more because of who you are? I mean,
well, like any journalist.
How would you characterize the relationship you have with Fidelity?
I think it's a professional relationship. Like any journalist, it depends on what story you wrote yesterday. And there are times when they get a little ruffled, and that's okay as long as I'm doing my job. I think there's an understanding, though, of professionalism where they afford me the same access to the investment managers and to their personnel as they would anybody in the media business.
You don't go out of your way to be either easier on a particular fund or more critical of a fund, given your position?
I don't think so. I think I'm cognizant of the responsibility I have to report it the way that I see it. And if that's to the benefit of Fidelity, so be it. If that hurts Fidelity, I have to do my job.
And how do you reach your shareholders? There, I said it. Your shareholders, your subscribers. Did you buy up Fidelity mailing lists, or how did that work?
No, Fidelity is very careful about letting their shareholder list out to the public. They consider their shareholder list with the same intensity being a private shareholder list as a bank would their accounts. But we go out and through marketing advertise the publication as well as through direct mail.
What do you think of Fidelity as an organization? Is it too large? Does it serve the needs of its shareholders in its funds? Or, I mean, you're obviously filling a niche that's not being met right now, in your view. Huh?
Well, certainly Fidelity is the largest by far. It has a tremendous array of funds. The fact of the matter is that Fidelity, over the long term, has had a tremendous return on their stock funds and many of their other funds. Their service is far superior to the average mutual fund family, and there's just about something for everybody for any investment climate. So I think that all in all, they've done a well above average job for their shareholders.
So your job is to pretty much be an ombudsman, standing on the sidelines, letting the average investor know what's going on at Fidelity and perhaps where to invest those funds as well, huh?
I think it's twofold. One is to tell them where to invest, but really to tell them what the funds are all about. It's an educational and informative tool for them. If they want to invest in technology, hopefully I'll point them in the right direction to identify those funds that will get the biggest bang for their buck if technology moves. If they want to invest overseas, I'll give them the lowdown of what the international fund offerings are and which ones hold promise.
Are people likely to call you if they don't get a hold of who they want at Fidelity, seeking advice?
Well, we don't consider ourselves a Ralph Nader of Fidelity shareholders. Really, we're interviewing them and we're researching their wares the same way that Fidelity goes out and explores the investment possibilities of IBM or General Electric.
So I'm an individual investor. I'm saving for retirement. It's 20 years down the road. I'm in a market climate right now that is a little iffy at the moment. Which of the Fidelity funds would you recommend right now?
I think there's a wide array of funds that you can choose from. To narrow it down, if you're looking for a growth fund, value fund is one of my favorites. Capital appreciation, a little bit more risky. But if you want to play the commodity inflation angle, that's a good choice.
So I have to make a decision of my view of the investment climate before I'm going to get into one of these funds.
Yeah, we do have a series of model portfolios that are explained in our report every month, and people follow that which is a group of Fidelity funds, and it changes with the environment and with changes in the funds themselves.
I'm already retired. I'm looking for more income. I'm not getting it from CDs. I've lost principal in my bonds, some of the bond funds. Where do I go in the Fidelity family?
They're Fidelity Balanced Fund, Fidelity Puritan, or balanced type. They have both stocks and bonds in the portfolio. Conservative bent, obviously they've been hit with the rise in interest rates, perhaps even more in some cases than some of the stock funds, but I think long-term those are the funds you want to look at. Also, junk bonds are a good alternative, and Fidelity has some of the best junk bond funds, Capital and Income, as well as Spartan High Income.
Anything you'd stay away from right now? Any funds that are underperforming necessarily?
Oh, I think there's lots of funds that are underperforming. The Utilities Income Fund has underperformed. We've seen the long-term bond funds. People don't understand how bond funds work, how they're different from buying individual bonds. You don't have the luxury of waiting until maturity. So I think the interest rate sensitive area is one area that I'd sort of stay away from, as well as the aggressive growth funds as well.
All right. Well, I know that you will have some questions. There are, how many did we say?
7 million.
7 million shareholders out there in Fidelity, not to mention the 125,000 people who are newsletter subscribers to Eric Coburn. So if you have any question for him, this is the time, gang. Get your calls in right now. 800-752-CNBC. We'll be back after this.
But you probably
And tomorrow night as well, a special edition of Your Portfolio. Indeed, we're going in the midst of the elections, the unprecedented elections going on in South Africa. We will devote tomorrow night's program to investing in Africa, primarily South Africa. Jimmy Rogers, our guest, my co-host here on Friday nights, who has been ahead of the curve for a number of years on investing in Africa. He is still very high on it, even though a number of people are already investing there and very high on it. He'll be our guest tomorrow night, so it's your chance to get his opinion on investing in Africa in these opportune times for investors in that country. Meantime, we're talking with Eric Coburn tonight, editor of the Fidelity Profit Alert and Fidelity Insight. Let's go to the phone and see what's on people's minds. Joe in Colorado, good evening.
Good evening.
Yes, sir.
Eric, some advertisements for your publication describe you as a, quote, ex-manager, end quote, at Fidelity. Exactly what did you do at Fidelity, and how does that qualify you to be an advisor to 125,000 subscribers?
I was a marketing director at Fidelity, covering the investor centers around the country for Fidelity. Prior to that, I was an institutional manager at Delphi Capital Management in Boston.
So you were not a manager at Fidelity?
No, I was not. No, I was not.
Why does the ad say you were?
It doesn't say that. It says that I was a manager at Fidelity. It does not say that I was a fund manager at Fidelity, but I was an executive with the firm.
You can understand why people might be a little mistaken about that, or it might be misleading? Do you think it is misleading?
I think that's the perhaps using a little bit of marketing savvy by the direct mail consultants that we use. But certainly I was on Wall Street since 1975. MBA from Columbia. Most importantly, for the past 8 years, I've spoken to more Fidelity fund managers than perhaps anybody on earth, including most of the managers at Fidelity themselves.
Fair enough. To Jack in Connecticut, good evening.
Good evening. I have a two-part question here for you. First part has to do with the new Fidelity Fund Mid-Cap Stock Fund. I'm interested in what you think of that over the long term especially. Seems like the fund manager, she's got a lot of good experience. Second question is, for the foreign funds, Latin America and especially Southeast Asia. These funds, as I'm sure you know, went up greatly at the end of '93 and then just took a nosedive. What do you think for the long term on both of these funds?
Well, for the first part of the question, the Mid-Cap Stock Fund is a new fund. Most new funds at Fidelity, most domestic stock funds at Fidelity in their rookie year do tend to outperform their averages. Time will tell whether or not this one also outperforms the averages.
Is there something about the organization that...
There's a lot of theories about it. It could be related to the fact that there are no assets there. The investment manager only has to make the decision to buy, not to sell.
We had a fellow here last night, started a fund in January, $5 million in REITs, Real Estate Investment Trust. It was #1 in its category in the first quarter, its first quarter of existence. Maybe there is something to that. When you've got very few assets, you can you don't have to diversify yourself as much.
That's right. He can concentrate on a couple of issues and make them run, and that's what happens.
Okay, Latin America,
Southeast Asia, two of the hottest performing funds last year. It goes to show that buying the top funds of last year is no key to success. I think those funds, that market in general, those areas of the market are way overdone. A lot of volatility. Those funds are now down around 23%. Latin America alone was down 8.5% last week, down 17.5% since the first of the month. Quite frankly, they're too sensitive for my taste, and I'd prefer to stay in the more developed countries.
All right. To Paul in California. Good evening.
Good evening. Nice talking with you. I had a question. If you could only pick one growth fund, one growth and income fund, and one international fund, which fund would you pick in each category?
Okay, Paul. I think in the growth category, Value Fund, as I mentioned earlier, is a good, solid fund. It's investing in the economy. It's investing heavily in energy stocks, in some of the aluminum stocks. And I think it's well diversified overall. It'll do fine. It's done fine for the last 2 years. Jeff Ubben, very qualified manager, runs the fund. And I'm looking for a good performance this year as well. So far, it's a #2 in the Fidelity's growth fund category year to date. Growth and income, equity income too. Similar fund, also betting on the economy, continuing to go strongly, little less aggressive than Value Fund. In the international category, international growth and income, looking at the developed markets in Europe, moving into Japan recently in the first quarter, about 30%, 25% of its assets are in Japan. that's the extent to which I would be in the international funds.
Okay. Up to Bob in Vermont. Good evening.
Hi, good evening. Thanks for taking my call.
Sure.
I wanted to ask about the Equity Income 2 fund and the Balance Fund. I'm in the Equity Income 2 fund for my IRA. Is that a good fund to be in for the IRA, or should I switch to another fund?
No, I think Equity Income 2 is fine. I think that sometimes you want more than one fund in one account depending upon your objectives, but Equity Income 2 both has stocks as well as bonds and plays middle of the road, has a dividend yield, should not be quite as aggressive, quite as volatile as the market in general. So I think it's a great choice.
What about the Balanced Fund right
Balanced Fund is a bit more conservative. Although it has been hit, it does have a large international exposure, got hit on the foreign currencies lately. But I think long-term, Bob Haber has proven to be a phenomenal manager. His performance versus the volatility of the fund has been stupendous. And for more conservative investors, I think it's a fine choice.
We've gone 26 minutes in the program. We've taken all these calls, and nobody wants to know about Magellan. What do you think of Fidelity Magellan?
Magellan actually has been upgraded recently. I think it's okay to buy. There's $33 billion under the stewardship of Jeff Vinnick up there.
What do you think of the job he's done?
He's done a phenomenal job. Right now, he's invested heavily in technology, energy, and the cyclicals.
So how long were you not advising people to buy it?
I had a hold on it for quite a few years. It is still a large fund. If you're looking for something to do 10 points better than the S&P, that's not the choice. If you're looking for a place to put your CD money or your money market money, that also is not the choice.
But now, in some circumstances,
absolutely,
it is.
I think it'll outperform the market by a few points a year.
Got it. Thanks, Eric.
Thank you.
See you. Eric Coburn joining us tonight, the editor of the Fidelity Profit Alert and the Fidelity Insight newsletters. And as I mentioned, we have a very special program for you tomorrow night. My colleague Jim Rogers here to answer your questions on investing in Africa. Jimmy's been very bullish on the continent for some time, and he'll be here to tell us which countries he feels offer the best opportunities investment in the long run. He'll also discuss what role a new South Africa might play in the continent's economic future. Should be a fascinating show, certainly a unique opportunity for you to talk one-on-one with Jimmy. And unlike a lot of people who profess to be bullish on Africa, Jimmy's actually been there. He should know. Here's Sue, and Janice Lieberman's back as well with a preview of what's coming up on Money Tonight.
Hi there, Bill. Sounds exciting for tomorrow night. Well, coming up next on Money Tonight, we'll take your phone calls for David Horowitz. If you think you've been the victim of a scam or ripoff, David will tell you how you can protect yourself in the future.
Also ahead, things are looking pretty bright on the economic front, right? So why is it that our paychecks don't seem to be getting any bigger? Is it the right time to ask for a raise? What should you do? We're going to find out next. Back to you, Bill.
Go ahead. You two first.
Chicken. Don't think it's a good... Never mind. I won't get into that.
See you later. Thanks. We'll see you in a few minutes. That's it for tonight. I know that we are up against Mr. Nixon's funeral tomorrow night. Tape one, watch the other, huh? What a good idea. Thanks for joining us, everybody. I'm Bill Griffith. See you tomorrow night.
This program is sponsored by Buick and your local Buick dealers.
When I was a teenager, Dad felt so good about Buick quality and safety, he let me drive.
Today, Buicks have better quality than ever. Every Buick has anti-lock brakes. Every Buick has driver or dual airbags. And every Buick has air conditioning refrigerant that won't harm the ozone layer. Everyone can feel good about that.
You want to drive?
Sure.
Let's go.
I'm riding shotgun.
When it comes to making investments, there is so much double talk.
It's a whole big puzzle, investing.
Everyone's made a bad investment.
For 25 years, I've been cutting through the wild and phony claims to find those few advisors who actually deliver the goods. Now my newsletter puts my unmatched experience and contacts on your side. It's a monthly lineup of investing all-stars that, quite simply, no other publication can match.
Call now to order Louis Rukeyser's Wall Street and get the first 3 issues free.
If you read the newsletter, you can become a savvy investor.
People tell us we're pretty good at making everyone who wants to be a savvy investor. I think that's because everything in the newsletter is very understandable and easily usable. The writing is clear and lucid, because the thinking is.
You can cancel your paid subscription to Louis Rukeyser's Wall Street at any time. It's risk-free.
Pick up the phone. There's no risk. You'll be on your way to investment success.
Read it and reap.